The lowest mortgage rate is not always the cheapest mortgage. That sounds wrong at first, but it becomes clear once you understand mortgage points. Mortgage points are upfront fees paid to lower the interest rate. 1 point usually costs 1% of the loan amount, so on a $400,000 loan, 1 point costs $4,000, 2 points cost $8,000. In exchange, the lender may offer a lower rate. That lower rate can reduce the monthly payment. But the question is not whether the payment goes down. The question is whether the lower payment saves enough money to recover the upfront cost. That is the break-even test. Let us use a simple example. Imagine a buyer can choose between two loans. Loan A has a 6.75% rate with no points. Loan B has a 6.5% rate but requires 1 point upfront. The buyer is borrowing $400,000. 1 point costs $4,000. Suppose the lower rate saves about $70 per month. To find the break-even point, divide $4,000 by $70. That is about 57 months, almost 5 years. So if the buyer keeps the loan for longer than 5 years, buying the point may eventually save money. But if the buyer sells, refinances, or pays off the loan before then, the point may not pay for itself. This is why mortgage points can be smart for one buyer and a trap for another. The same rate offer can be good or bad depending on time. If you plan to stay in the home for 10 years and the break-even point is 4 years, points may make sense. If you plan to move in 2 years and the break-even point is 5 years, points probably do not make sense. But buyers often do not see it this way. They see the lowest rate and think it must be the best deal. That is the illusion. The rate is only one part of the deal. The cost to get that rate matters too. This is why the loan estimate is so important. Two lenders may both advertise 6.5%, but one lender may charge points. Another may not. One may have higher origination fees. Another may have lender credits. If you only compare the rate, you can pick the more expensive loan by accident. Now let us talk about lender credits. Lender credits are almost the opposite of points. Instead of paying more upfront to get a lower rate, the borrower accepts a higher rate in exchange for lower upfront costs. This can make sense if cash is tight, or if the borrower does not expect to keep the loan very long, but it also raises the monthly payment. Again, the decision is not automatically good or bad. It depends on the break-even math. Mortgage points are really a timing decision. Pay more now to pay less each month later, or pay less now and accept a higher monthly payment. Neither answer is always right. The right answer depends on how long you keep the loan, how much cash you have, and what else that cash could be doing. There is also a risk with forecasts. Some buyers pay points because they think they will keep the mortgage for many years, but then rates fall and they refinance, or life changes and they move, or they need to sell. If that happens before the break-even point, the points may have been wasted. This is one reason buying down a rate can be risky in a market where people expect rates to change. If you're likely to refinance soon, paying a large upfront cost to lower the rate may not make sense. But if you want payment stability and expect to keep the loan for a long time, points can be worth analyzing. The key is to calculate, not guess. Before paying points, ask these questions. How much do the points cost in dollars? How much do they lower the monthly payment? What is the break-even month? How long do I realistically expect to keep the loan? Could I use that cash better somewhere else? And does the lower rate still look good after comparing the full loan estimate? Here is the clean rule. Do not buy a lower rate just because it looks better. Buy it only if the math works for your timeline. A beautiful rate with a bad break-even point is not a bargain. It is just a fee wearing a discount label. Mortgage points can save money. They can also quietly waste money. The difference is the break-even point. There's another detail that makes mortgage points confusing. The value of a point changes with the loan size and the size of the rate reduction. Two buyers can both pay 1 point, but the savings may not be the same. One lender might reduce the rate by 0.25%. Another might reduce it by less. The cost of 1 point is easy to understand. It is usually 1% of the loan amount, but the benefit is not fixed. The benefit depends on the lender's pricing, market conditions, loan type, credit profile, and the size of the rate reduction. That is why the buyer should not ask. How many points does this cost? They should ask, what is the dollar cost, what is the monthly savings, and what is the break-even month? Those three numbers are the decision. There is also an opportunity cost. If a buyer pays $8,000 in points, that money cannot be used for something else. It cannot be used as a larger emergency fund. It cannot be used for repairs after moving in. It cannot be used to pay down high-interest debt. It cannot be used for moving costs, furniture, or cash reserves. So even if points eventually save money, the buyer still needs to decide whether tying up that cash is wise. This is especially important for first-time buyers. Many first-time buyers underestimate the cash needs after closing. The home may need small repairs. Insurance may be higher than expected. Utilities may surprise them. Furniture and moving costs can add up quickly. If paying points leaves the buyer cash poor, the lower rate may create a different kind of risk. Again, the answer is not that points are bad. The answer is that points are a trade. They trade cash today for a lower payment over time. That trade works best when the buyer has enough cash, expects to keep the loan beyond the break-even point, and does not need that money for more urgent uses. It works worst when the buyer is already tight on cash, likely to move soon, or likely to refinance before the break-even month. One more thing, points can make comparison shopping harder. If lender A quotes 6.25% with points, and lender B quotes 6.5% with no points, the lower rate may not be the cheaper offer. The only fair comparison is to line up the loan estimates side by side, compare the rate, compare the APR, compare points, compare lender fees, compare cash to close. Compare the monthly payment, then calculate the break-even point. The best mortgage is not always the one with the prettiest rate. It is the one with the best full cost for the borrower's timeline. Educational content only. This is not financial, mortgage, tax, or legal advice. Always compare real loan estimates from licensed lenders before making a mortgage decision.